Module 3, Business Planning and Strategy. Welcome to Module 3 of our Mastering Entrepreneurship course. In this module, we'll delve into the critical aspects of business planning and strategy. Developing a well-structured plan is essential for turning your business idea into a successful venture. Let's explore the content in detail. 3.1 Writing a comprehensive business plan. This section will cover the process of creating a business plan. You'll learn about the key components, including the executive summary, company description, market analysis, organization structure, and financial projections. By the end of this section, you'll have a draft of your business plan. Writing a comprehensive business plan is a structured process that involves documenting all the essential aspects of your business, from its concept to its operational and financial strategies. Here's a step-by-step guide on how to write a comprehensive business plan. 1. Executive summary. Begin with a concise executive summary that provides an overview of your business, its mission, and the key points of your business plan. This is typically written last but placed at the beginning. 2. Business description. Provide detailed information about your business, including its name, legal structure, example LLC, sole proprietorship, location, history, and any unique selling points. 3. Market analysis. Describe your target market by identifying your customer segments, their demographics, needs, and behaviors. Analyze your competitors and market trends. 4. Products or services. Explain what products or services your business will offer. Highlight how they meet customer needs and provide a solution. 5. Marketing and sales strategy. Outline your marketing and sales plans. Describe how you'll attract and retain customers, your pricing strategies, distribution channels, and promotional activities. 6. Organization and management. Introduce your team members, their roles, and qualifications. Provide an organizational chart and explain how your business will be managed. 7. Funding request. If applicable, if you're seeking funding, specify the amount you need and how it will be used. Include a detailed budget and financial projections. 8. Financial projections. Present your financial forecasts, including income statements, balance sheets, and cash flow statements. These projections help assess your business's financial viability. 9. Appendix. Include supplementary documents, such as resumes, market research, legal agreements, or any other relevant information. Tips for writing a comprehensive business plan. Research. Thoroughly research your market, competitors, and industry. The more data you have, the more informed your decisions will be. Clarity. Use clear and concise language. Avoid jargon that might be difficult for readers to understand. Realistic projections. Be conservative in your financial projections. Overly optimistic figures can undermine your credibility. Customer-centric approach. Emphasize how your product or service addresses customer needs and pain points. Flexibility. Your business plan should be a dynamic document, updated as your business evolves. Seek feedback. Share your plan with mentors, advisors, or potential investors to get valuable feedback. Keep it professional. A well-organized and visually appealing document is more likely to make a positive impression. Writing a comprehensive business plan is a vital process for setting clear objectives, attracting investors, and guiding your business's growth. It serves as a roadmap to help you navigate the challenges and opportunities of entrepreneurship. 3.2 Market strategy and positioning. Understanding your market and where your business fits within it is crucial. We'll explore market segmentation, competitive analysis, and defining your unique value proposition. You'll develop strategies for entering the market and positioning your business effectively. Marketing strategies and positioning are essential components of a business's overall marketing plan. They work together to create a clear brand identity, target the right audience, and communicate the unique value a product or service offers. Here's an explanation of these concepts. Marketing strategies. Marketing strategies are comprehensive plans that outline how a business will promote its products or services to achieve its objectives. These strategies involve a combination of activities, tactics, and channels used to reach and engage with the target audience. Some key elements of marketing strategies include: 1. Target audience. Identifying the specific group of people or businesses that are most likely to purchase your product or service. This involves creating buyer personas to understand their needs and behaviors. 2. Marketing mix. Developing a marketing mix that encompasses the 4 Ps: product, price, place, and promotion. This helps define what you're selling, at what price, where it's available, and how you'll promote it. 3. Market segmentation, dividing the market into segments based on common characteristics such as demographics, geography, psychographics, or behavior. This allows for tailored marketing efforts. 4. Positioning, creating a unique place in the minds of consumers by emphasizing your products or services' distinct features, benefits, and value compared to competitors. 5. Channels and tactics, identifying the channels and tactics for reaching your target audience. This can include digital marketing, social media, content marketing, email campaigns, SEO, advertising, and more. 6. Budget and resources, allocating the appropriate budget and resources for each marketing initiative. This ensures that you have the means to execute your strategies effectively. 7. Measurement and analysis, defining key performance indicators, KPIs, to measure the success of your marketing efforts. Regularly analyze data to make informed decisions and refine your strategies. Positioning. Positioning is a marketing strategy that focuses on how a product or service is perceived in the minds of consumers relative to competitors. It's about creating a unique and compelling position for your brand or offering. Key aspects of positioning include: 1. Differentiation, identifying what makes your product or service unique or distinct from others in the market. This could be based on features, quality, price, or the problems it solves. 2. Target audience, understanding the specific needs, desires, and preferences of your target audience and how your product or service addresses those needs. 3. Value proposition, clearly communicating the value your product or service delivers. This is often expressed in a unique selling proposition, USP, that highlights what sets your offering apart. 4. Competitive analysis, assessing how competitors position themselves and identifying opportunities to create a position that differentiates your brand. 5. Consistency, ensuring that your positioning is consistent across all marketing efforts, from advertising and messaging to customer interactions and branding. 6. Relevance, positioning should align with current market trends and consumer perceptions. It should be relevant and resonate with your target audience. Effective positioning establishes a strong brand identity and helps consumers understand why your product or service is the best choice. It can be a powerful tool for building customer loyalty and increasing market share. 3.3 Financial projections and funding options. This section dives into the financial aspect of your business. You'll learn to create financial projections, including income statements, balance sheets, and cash flow forecasts. We'll also discuss various funding options, from bootstrapping to seeking investors. Financial projections and funding options are essential aspects of planning and managing a business. Financial projections involve estimating future financial performance, while funding options encompass various ways to secure capital to start or grow your business. Here's an explanation of both concepts. Financial projections. Financial projections are detailed forecasts of a business's financial performance over a specific period, usually the next 1 to 5 years. They provide a snapshot of expected revenues, expenses, profits, and cash flow. Key components of financial projections include: 1. Income statement. This shows expected revenues, costs, and profits. It includes sales, cost of goods sold, operating expenses, and net income. 2. Balance sheet. The balance sheet lists a company's assets, liabilities, and equity. It provides a snapshot of the business's financial position at a specific point in time. 3. Cash flow statement. This tracks the inflow and outflow of cash in the business. It includes cash from operations, investments, and financing activities. 4. Break-even analysis. This helps determine the point at which your business will cover all its costs and start generating profits. 5. Financial assumptions. Clearly state the assumptions underlying your projections, including sales growth, pricing, expenses, and market conditions. Financial projections are crucial for various reasons, such as attracting investors, securing loans, setting budgets, and making strategic decisions. They should be based on realistic data and careful market analysis to be valuable for guiding business operations. Funding options. Securing the necessary capital to start or grow your business is a critical step. Different funding options are available, each with its own characteristics and requirements. Here are some common funding options. 1. Bootstrapping. Using your savings, personal assets, or revenue generated by the business to fund its operations. Bootstrapping is often the most straightforward and least risky way to start a business. 2. Debt financing, borrowing money through loans or lines of credit. This can be from banks, credit unions, or alternative lenders. Debt financing involves repaying the borrowed funds with interest. 3. Equity financing, selling ownership stakes, equity, in your business to investors in exchange for capital. This can involve angel investors, venture capitalists, or crowdfunding platforms. 4. Crowdfunding, raising funds from a large number of individuals or investors through online platforms like Kickstarter, Indiegogo, or equity crowdfunding platforms. 5. Grants and competitions, seeking grants or entering business competitions to secure non-repayable funds for specific projects or innovations. 6. Small business loans, many governments and organizations offer loans specifically designed for small businesses, often with favorable terms. 7. Venture capital, attracting venture capital from professional venture capital. Firms can provide substantial funding for high-growth startups. In exchange, you may need to give up a significant equity stake. 8. Angel investors, high-net-worth individuals who invest their own money in startups. They often provide not only funds but also mentorship and valuable connections. 9. Business incubators and accelerators, participating in business incubators or accelerator programs, can provide funding, mentorship, and resources to early-stage startups. Each funding option has its pros and cons, and the choice will depend on your business's stage, financial needs, and your willingness to share ownership or repay debt. It's important to thoroughly research and consider the implications of each option before making a decision. 3.4 Risk management and contingency planning. Every business faces risks. In this section, we'll examine common risks and how to manage them. You'll learn about contingency planning, risk assessment, and insurance. Preparing for the unexpected is a key component of a robust business strategy. Risk management and contingency planning are essential components of business strategy, aimed at identifying and mitigating potential risks to ensure the resilience and continuity of a business. Here's an explanation of these concepts. Risk management. Risk management is the process of identifying, assessing, and mitigating risks that could affect a business's objectives, operations, or assets. It involves a systematic approach to managing uncertainties and minimizing the impact of potential negative events. Key components of risk management include 1. Risk identification, identifying potential risks that could threaten the business, whether they are financial, operational, strategic, or external in nature. 2. Risk assessment, evaluating the likelihood and impact of each identified risk. This involves assigning a risk rating or score to prioritize which risks require attention. 3. Risk mitigation, developing strategies and actions to reduce or eliminate risks. This can involve risk avoidance, risk reduction, risk transfer, example insurance, or risk acceptance. 4. Monitoring and review, continuously monitoring and reviewing the effectiveness of risk mitigation measures. This ensures that the business remains prepared for evolving risks. 5. Contingency planning, preparing contingency plans to respond to and recover from adverse events when they occur. Contingency planning. Contingency planning is the process of creating a plan or set of procedures to address and recover from specific risks or unexpected events. It outlines the steps to be taken when risks materialize to minimize disruptions and maintain business continuity. Key elements of contingency planning include 1. Risk-specific plans, developing plans tailored to address the unique challenges posed by specific risks. For example, creating a contingency plan for data breaches, natural disasters, or supply chain disruptions. 2. Response protocols, clearly defining the actions to be taken when a risk event occurs. This includes roles and responsibilities, communication strategies, and resources needed for response. 3. Business continuity, ensuring that essential business functions can continue or resume quickly after a risk event. This may involve backup systems, redundant processes, or relocation options. 4. Communication strategies, establishing protocols for communicating with employees, customers, suppliers, and other stakeholders during and after a risk event. 5. Testing and training, regularly testing and training employees on contingency plans to ensure they are well prepared to respond effectively to risk events. 6. Documentation and records, maintaining detailed records of contingency plans, procedures, and responses for compliance, analysis, and post-event evaluation. Risk management and contingency planning are interconnected processes. Effective risk management identifies potential threats, while contingency planning prepares the business to respond to those threats. Both processes are crucial for maintaining business resilience, minimizing financial losses, and ensuring that operations continue as smoothly as possible, even in the face of adverse events or uncertainties. This concludes Module 3. Good luck and